Hello and welcome to Game of Trades. My name is Peter, and today we're going to go back in history. We're going to go back far into the charts so that we can compare different moments in history to what we've recently seen over the past year. It's been around 52 weeks since the March low right here, and throughout this period we've had one of the largest rallies in history. So what does it mean for the stock market? Is this a final move of exhaustion, or is this the beginning of a massive super cycle? This is what we're going to be covering in this episode. As always, make sure to hit the like button as hard as you can. Now, without further ado, let's get right into it. So I've added an indicator on this chart called the rate of change. So this is a very simple indicator. It's very easy to use, easy to understand. And one way to explain it, one way to understand what it is momentum. The rate of change is momentum in its purest form. So you can see I've added a little number here, and that corresponds to the time period that we're looking at. So this is 52 weeks. This is a weekly chart, right? Going back to the 1990s. So what this indicator measures is the market momentum throughout the last 52 weeks of price action. And what you'll quickly notice we have right here in 2021 is a huge spike in the rate of change, a huge spike in momentum over the last 52 weeks. Now we can take a look at how many times this actually happened in history, and you can see the last big spike we had on the rate of change was in 2010, right after that bear market low from 2009. And so I'm going to put a line right here, and we're going to go back in history to see if we have any more of these readings. So let's zoom out a little bit here and go back further, and you can see we've got one reading over the last 50 years, since 1970 all the way till 2020. We've got one reading in 2021, one in 2010, and one in 1983. So what does this all mean? And I want to quickly put up a chart from stockcharts.com highlighting exactly what this means. And you can see right here, you've got the first part of that uptrend with a huge thrust in momentum. This is what you call a momentum thrust. When you have a huge movement like this, it's often the first big move of an uptrend. That's when the momentum is the strongest. And then as the uptrend progresses, you start to see divergence in the uptrend. And so we can quickly take a look at that. For example, here, first big move up of the bull market, you have a momentum thrust. And then as the bull market progresses, the momentum fades, and you start to see divergence, telling you that that move is slowly coming to an end. Right here, you've got a rise in the price, and you've got the rate of change starting to come down right here, telling you that this move up is getting ahead of itself and it needs to correct. So here you had the sideways bear market of 2015 and 2016, right after that big divergence in the momentum. So it works. What does this actually mean? And this is actually part of the reasoning why many are starting to believe that stocks are heading into a multi-year bull market, which would make this a massive super cycle. And that's definitely an interesting concept to play with, but there are a couple of key differences between what's happening in 2021 and what happened back here and in 1983. And the big difference is that these moves, these momentum thrusts, came after multi-year periods of sideways action on the markets. And we can actually measure that right here. If we measure the stock market performance throughout the previous 10 years before that momentum thrust, you can see right here since 1999 till 2010, it was flat. It was a 0% return on the stock market. And if we go to 1983, 10 years before 1983 was 1973. And you can see the returns were extremely low throughout that period. The market was in a sideways period of consolidation leading up to that momentum thrust. And of course, in 2021, 10 years before, that's in 2011, and we can measure that up. That's around 190% up since 10 years ago. So we are clearly not in exactly the same situation than in 2010 and 1983. So why are we getting a major thrust in momentum right after one of the longest bull markets in history? And you probably guessed it, it's all about the money supply. Look at what happened to the money supply growth rate since 2020. We've had an unprecedented injection of capital into the economy. And the very first place that shows up is in the stock market. Is this actually going to lead to a bull market super cycle over the next decade, or is all this stimulus going to lead to a hyper complacent market that gets overextended, too greedy, and that eventually needs to deflate? And so in this next part of the video, I'm going to show you exactly how we're going to be able to tell whether we are heading into a complacent market like during the 1990s, or if we're right in the middle of a major bull market super cycle like between 1983 and 2000. So in order to answer that question, we need to take a look at the two big characteristics of bubbles. The first one being extreme overextended conditions. You can see this massive rally here. These are overextended conditions, and there are precise ways to measure this price action compared to healthy bull market price action like throughout this period right here. And the second big characteristic is extreme bullish sentiment. Again, throughout this period right here, leading up to that top, we had extreme bullish sentiment. And again, there are ways to actually measure that. So the first thing we're going to take a look at is the percentage difference between the price and the 40-week moving average. This is one of the best ways to see how overextended the price is, and so how the markets react to those overextended conditions. So we're going to start by putting another line here on this indicator that's going to help us judge when price is overextended and when it's in a healthy trend. So I've put this line here at around the 10-point mark on this chart, and I'm going to put a horizontal line every time this indicator tags that line. So we've got one right here in January 2018. Shortly after that tag, you had a correction before eventually resuming the bull market. Let's expand this a little bit so that we can see this better. This is not a tag. This is a tag right here in 2011. And again, shortly after that reading, the market's corrected. Now let's go back a little bit further. Right here in 2004, you have a tag of that line right there, and that's followed by another correction. And let's see what happened throughout the dot-com bubble. And you can see between 1995 and 1999, you have several tags of that line, telling you that price often stays overextended for long periods of time. And so you can say throughout this period between 1995 and 1999, you were in a very complacent environment. We can go back a little bit further to see what happens throughout a normal bull market. And again, you've got a tag of that line right here in 1989, and you've got that followed by a nice correction. So that's healthy price action. That's not complacency. This is complacency. So let's go back a little bit further to 1987. And right here, you've got another complacent market with multiple overextended readings, one after the other, leading to the 1987 crash. And you can see the 1987 crash right here retraced all the gains that were made between that first complacent reading and the top of that market. So let's zoom out and get a clear picture of what's going on here. And you can clearly tell the difference between a complacent market with multiple overextended readings and a healthy market with an overextended reading every once in a while. And you can see right here, what do we have? We've got the first big overextended reading. But if we zoom into what's happening here, we're not getting that correction just yet. So we're going to see what happens. We know the market is overextended right now. If we see a correction working off those overextended conditions before resuming the bull run, that would be healthy price action, and that would fall into the healthy bull market category. But if we continue going up here, and I'm going to show you in just a second exactly what we're on the lookout for, that could fall into the complacency camp and could suggest that we're heading into bubble territory. So now the next indicator we're looking at is the AAII Bulls survey. So this is the best measure of sentiment out there, telling you how many investors are bullish on the stock market over the next 6 months. And you can see there's an indicator that varies between extreme optimism in red and extreme pessimism in green. So we've covered this before, we've taken a look at this before, but we're going to do it a little bit differently this time and apply the same concepts of comparing healthy bull markets to periods of complacency. And you can see right here, during a healthy bull market, you have spikes in bullish sentiment throughout the bull market that lead to periods of sideways consolidation and then a resumption of that uptrend. You can see back in the early 90s, it was a similar scenario. You had a spike in bullish sentiment followed by a correction, then a few odd spikes here, then a period with bearish sentiment throughout 1993 and 1994. And then suddenly in 1996, you start to have overly bullish sentiment. And this is where things get dangerous, when you start to see the sentiment hover around that red line for extended periods of time, multiple times in the same time period, and towards the top, you start to really get these extreme readings in sentiment. And so again, we're going to be able to take a look at that right here because we've had already one spike in sentiment in 2020. Now we're getting another spike in sentiment as we speak, and yet we're not getting a correction in the markets. Is this a sign of an early complacent market that could quickly head into bubble territory with investors getting too confident in the easy monetary policies pushing the stock market up? So what we're looking at on the stock market, more specifically on the S&P 500, is this line here. This is what the past few videos have been centered around. The stock market is at major resistance. We're overextended. We're very complacent. So if we really are in a healthy bull market, we should be getting a correction back to around that blue line before resuming that uptrend. If the markets break out here, that's a sign of hyper complacency because that's the precise moment where the uptrend is going to start to accelerate. Now, in either case, we believe that there's still a lot of money to be made in the stock market, whether we buy the dip here or we wait for that breakout and buy the dip on the back test. There will be plenty of opportunities as long as we don't see the signs that we talked about in our video, how to predict a stock market crash. Now, if you're interested in more content from us, you can check out gameoftrades.net. Just today, we posted an update on emerging markets backtesting their major long-term support, and also an update on Bitcoin and Tesla. That was actually a request from one of our members on the trading room. So if you're interested in finding out more about our trading strategies on different asset classes and investment strategies where we highlight our specific entries and exit points for the investments that we're actually bullish on for the long term, you can check out our free trial at gameoftrades.net. Now, that's about all I wanted to cover in this episode. If you enjoyed, make sure to drop a like and subscribe to the channel if you haven't already. In the meantime, good luck on your trading and see you next time.